Good evening, students. This is Teacher Wem. Right now, we are going to be looking at the accounting equation. Here is the accounting equation. Assets equals to liabilities plus owner's equity. The equal sign separates the left and the right. The left is assets. On the right hand side, you see liabilities and owner's equity. They have to be equal all the time. Alright, so we are going to be looking at the changes that can be made in an accounting equation when a transaction takes place. What kind of transaction? In this video, we are going to see the transactions that are the kind of transactions that affect the owner's equity. So we will be focusing on this side, owner's equity, okay? So when I say owner's equity being affected, I am referring to revenue or expense. Alright? So revenue, let's remember, revenue is when owner's equity increases. Expense is the contrary. When owner's equity decreases, we call them expenses. Okay? So let's look at the first transaction, first example. Transaction goes like this. On January 10th, receive cash from sales $1,100. Receive cash from sales $1,100. Okay? So as we know, cash is first question. What is cash? Is cash asset? Is cash liability or owner's equity? Definitely it is asset. Here I'm gonna put cash. Cash is an asset, and the transaction goes like receive cash from sales $1,100. Cash is increase $1,100. Okay? How do you receive cash? From sales, right? From sales. Okay? So here under owner's equity, which account is being affected? Remember, owner's equity is not the account title. The account that is being affected is the capital account. Okay? Here I'm gonna put the name of the owner, Mike Capital. Okay, Mike Capital is increase. Gonna move it here plus 1100. Okay? And how do you increase my capital? You do revenue. Okay? Let's remember that revenue is sales. Okay? The word revenue is synonymous to sales. When you make revenue, that means when you sell something. Okay. You see that the accounting equation is still equal because on the left hand side you have 1,100 more. On the right hand side you have 1,100 more. Equal. Nice. Very nice. Okay. Now let's look at another example. Another example is selling something on account. Selling something on account. Okay? When you sell something on account, Now, when you sell something on account, you are not receiving cash at the moment. So let's say you sell a merchandise or a service to a person. The person say, "Hey, I cannot pay you cash right now because I don't have any. Can I pay you tomorrow?" And you go like, "Yes, of course. You're a good person. I trust you." Then you are selling something on account. Okay? When you sell something on account, the asset that is obtained is what we call the account receivable. So account receivable is an asset. It is a good stuff. Okay, it is good for you. It is a debt in favor of you. Okay, we call it debt in favor of the business. All right, account receivable is a debt in favor of you. On the contrary, account payable is your liability. Okay, so you have to make sure you are able to differentiate the two. One is in favor of you, the other one is against you. Okay, so now let's read the transaction. The transaction goes like January 12th, sold services on account to Men's Tree Services, $500. Okay, so you are selling services on account to Men's Tree Services, $500. That tells you you're making a sales. Are you? Yes, definitely. You are selling something, but you are not receiving cash at the moment. Okay? So now we know that when you sell something, it doesn't matter if you receive cash or not, you increase your owner's equity. Okay? So in this case, my capital increases. I'm going to put plus $500. My capital plus $500. How do you increase my capital? By doing revenue, by selling stuff to who? To Men's Tree Services. Okay, I'm gonna put this here, and your asset in this case is a cash. No, definitely not. You are not receiving cash. You are not receiving cash. You are receiving account receivable. Okay, Men Trade Services. How much is it? $500. I'm gonna change the color a little bit. It's so creepy. Yep. Alright. Okay. Again, you see, when you sell something, your owner's equity always increase. Doesn't matter if cash is received or not. In this case, cash is not received. Okay, very good. Now, you know that sometimes, as a business owner, you don't make money all the time. Sometimes you have to spend money. Okay? So when you spend money and that decreases your owner's equity, then it is called expense. It is called expense. You see that expenses are the amounts that are being spent for the operation of the business. You have different kinds of expenses. Okay, there are different kinds of expenses, such as you have the expenses. All right, you have utility expenses, utilities. You have rent expense. You have also gasoline expense. You have advertising expense, and you have salary expense, etc., etc. Okay, so expenses lowers the owner's equity. Okay, let's be aware of that. It lowers the owner's equity. Let's look at some transactions that illustrates the lowering of your owner's equity. It says January 12, pay cash for communication bill for cell phone and internet service, $80. So obviously, you pay cash. Is that right? You pay cash. Cash is paid. How much is paid? Cash is paid $80. Okay? I'm gonna put minus here. Okay, minus cash. Owner's equity is also affected. I'm gonna put minus 80, and that is expense. All right. So you see here that when you pay cash for expense, your owner's equity decreases. Okay? Expense is not the only way to lower the owner's equity. You can also lower your owner's equity by withdrawal. Withdrawal is when the owner takes asset out of the business. Assets taken from the business for the owner's personal use is called withdrawals. Alright? And now let's read one transaction to help us understand. January 16, the owner withdrew equity in the form of cash, $350. Okay, so the owner takes money out of the business, $350. Here you put cash minus 350. Owner's equity is also, you're going to put withdrawal minus 350. Okay? Very good. Now we have learned how accounting equation is affected when the owner's equity is being altered.